Welcome back to the Market Stalkers channel. My name is Dee and I've been trading futures for the last 10 years. This time I'm going to be going over some misconceptions about supply-demand trading. Supply-demand is also known as institutional order flow, and it is one of the three order flow concepts out there, all three quite a bit different. It's quite likely that you've already heard about supply and demand trading, which is why you're on this channel. You may have also heard the terminology order blocks. But anyways, I will be using all of these terms interchangeably to mean exactly the same thing. Now, just in case that you've never heard of it before and you don't know what it is, effectively all order flow trading concepts aim to spot the levels where the larger institutional players are located or where they were located in the past. So why is this so important for any good trading skills? Well, because the larger institutional traders are the ones with enough buying or selling power to cause big price movements, big price changes. It's not going to be like your mate Dave down the road who's like trading one contract on ES, or your other mate Trevor who trades 2 full contracts on a 50k Apex challenge. No, because the ones causing these large moves are hedge funds, official members of the exchanges, banking institutions, commercial hedgers, and so on. Order block trading comes in many forms. There are many versions of it. One of the more popular versions out there is the one by the Online Trading Academy. Well, OTA, Online Trading Academy, they actually got sued because they tried to sell supply and demand trading to pensioners as a good way to invest their pension. As a result, losses that were incurred by some of these individuals went into like billions of dollars. And why was this really wrong? Well, because order block trading or supply and demand trading, it's not really investing, okay? It's active trading. Any active trading carries a lot of risk to it because is heavily tied to the person's psychology. Does this mean that the concept itself doesn't have any merit? Well, no, it absolutely has merit. I've been trading through a version of this concept since 2008, and this is still what my weekly plan is based on. But I want to address a problem, a misconception that I've come across while coaching traders personally over the last 3 years through my comprehensive Market Stalkers Pro Development Program. It's the program where I show you how I do it and how to improve your performance and trade properly via some professional trading tools. I also have a lot of proprietary concepts in there. So what is this very widespread issue? Well, a lot of people seem to think that supply and demand is a very valid approach to trade intraday, only using supply and demand. So let me say it here. Supply and demand, aka order blocks, are not meant for intraday trading, okay? No matter what you might have seen on YouTube, no matter what you might have seen on sites like Set and Forget, we've created algorithms to test these online supply and demand rules, and as pure intraday strategies, they all failed miserably. They were just about okay with some swing trading products, but you'd have to use like weekly and daily charts. But that would be medium-term trading. You know, swing trades on very particular products that move in generally just one direction. And then those medium swing trades would last anywhere from 1 month up to about 6 months. And even that gave a profitability that wasn't that great. It was like 35%. But the reason why it works as a swing trading strategy is that order blocks aim for that large risk reward ratio of like minimum 5 times of what you initially risked, right? So that forgives a lot of the mistakes and the inaccuracy that these levels inherently have. The algorithm that we tested was quite a bit improved when we introduced some signals that wait for the price to turn at a level first before actually entering a trade, meaning you wait for some kind of a reversal in price first. And then the order blocks on like weekly and daily charts kind of bumped up the accuracy to around 40%, even up to 42% in some cases. But generally, you're looking at a low frequency trading strategy. You'll be like doing 1 or maybe 2 trades a month. But when it comes to intraday, you have no real way to read intraday open sentiment for that particular session. It's a very, very big issue. Now, open sentiment is an incredibly important intraday speculative tool that does give a high accuracy, very high accuracy, and detail about which direction is the most highly probable that can occur in the first 2 to 3 hours of exchange trading. Order blocks, supply demand, it can never give you that information. You have no way of seeing whether the overnight inventory went too short or too long. Now, I learned a form of this order block trading from directly from a friend of mine who worked for banks. The terminology is kind of similar, but the time frames and the basic premise of what the order blocks are used for is like heaven and earth. Now, don't get me wrong, there is a use for supply and demand intraday. I use it to see where the large sellers or buyers stepped in during that first hour of the trading range. Not during inactive hours, not using a 4-hour chart created overnight and then calling that a consolidation or a base. And this is where my method of trading, the Market Stalkers method, differs from some of the other educators who teach a similar concept. Because I only personally trade intraday, but I do base my weekly trading plans on this supply and demand analysis. However, for intraday, for actual trade locations intraday, I primarily use market profile and statistical averages to find my high probability levels. So my version of supply and demand for intra-session trading can only be taken into the account if the market sentiment matches that day. Okay? If the auction has maybe not been very strong, or as a potential problem area on the way to my target from a setup that was taken from a TPO profile and looking at an auction process, how successful or unsuccessful that process was. It's not like a be-all and end-all for all trade locations. Far from it. It's literally just a tiny supportive factor. And it is also the reason why in my Udemy supply and demand course, you will never really see any live trading from supply and demand areas, because I don't use it like that. It's not fit for that purpose. Now, the second misconception is that supply and demand can't be successfully used for swing trading positions using timeframes like 1 hour and 4-hour charts, with a view to hold these trades for a few nights or overnight or even a couple of weeks. But 1 hour and 4-hour charts, they're intraday timeframes. So what's going to happen if you're attempting to use this intraday timeframe to hold an overnight position? 9 times out of 10, you're going to get stopped out. That's what you're going to get. Or you're going to wake up to a massive loss. There's several reasons why this particular thing happens. It's because of a particular intra-session behavior that happens. So let's say that you're located in like Australasia somewhere, or you're trading the London session. So you identify a level on a 1 hour or a 4-hour chart, and that level scores super high, right? So you whack in a limit order, you get your entry, you have the stop loss above or below the entire supply and demand zone, as they like to teach you. But then you go to sleep, the New York session kicks in, and your level is blown out of the water. Why? Because USA markets are the most liquid markets in the world. They have a lot of impact on price. A lot of my viewers and students are actually located in the United States. And even they struggle to hold positions through Asia and London, but for a slightly different reason. A lot of sort of more novice traders and hobbyist investors, they think that the markets just kind of go up or down in one direction in a single day. But actually, whoever observes the markets objectively for any length of time, you will notice that the markets have an ebb and flow to them. And that the days where the market just shoots up or falls in one direction are actually very rare. The most likely outcome, especially in the futures markets, which is what we trade here, and they're the most liquid asset class in the world, some folks might have realized that one session takes the price in one direction, but then the next session kicks in and it takes it in another direction, and so on and so on. So if you hold a position overnight and you don't have a stop loss that is large enough to account for that opposite move, when the next session kicks in, what's going to happen?
You're going to get stopped out.
You know, you can't trade intraday with massive stop losses because you'll never have the opportunity to gain 2 to 3 times of what you risk initially within that one session. Swing trading and investing counts on this extra time, extra trade duration to, supposedly bring you a larger risk-reward ratio on your trades. Supply and demand purists, they're all obsessed with getting 7R and 10R multiples. So they carry that kind of an expectation into intraday. But if you're an intraday trader, or you're someone who's choosing your trade locations from an intraday time frame, you have like a double whammy of a puzzle on your hands. You have to be right on the direction, and you have to be right within a very small period of time. Like, you don't have days or weeks on end to wait in case you get it wrong. Everything happens within minutes, because the smaller the stop loss, the more sensitive your position to intraday whipsaws and changes of price. If you want to be a true swing trader, then you need to really move away from these super liquid intraday markets and base your trade locations on the daily and weekly charts. You have to trade the products that are suitable for that kind of strategy. Not like on a 1 hour and 4 hour charts and then complain,
oh, it's not working.
And also you cannot expect a super high hit rate on swing trades, because the strength of swing trading strategies is not in high accuracy, but rather in a higher risk reward ratio. And anytime you're dealing with hit rate versus risk reward ratio, you have to sync them up, because they work, both of those measures work in a very fine balance. They're not isolated components, but more on that some other time. Now, if you want to know more about order flow trading strategies and how, for example, how not to use the point of control, because a lot of people use it in a wrong way, then you really need to watch this video.